Double cycle billing. You pay off most of your credit card balance. You check your next statement expecting a small interest charge. Instead, the bank charges you interest on money you already paid back. That's not a glitch. That was the rule. Before 2009, credit card companies used something called double cycle billing. Here's how it worked. Instead of calculating your interest based on what you currently owe, the bank would average your balance across 2 billing cycles, the current month and the previous month. So let's say you carried a $5,000 balance last month. This month you paid it down to $500. You'd expect to pay interest on that $500. But with double cycle billing, the bank averaged your 2 months together. 5,000 plus 500 divided by 2, they charged you interest on $2,750, even though $4,500 of that was money you'd already paid back. At a typical credit card APR of 18%, that's roughly $41 in interest on money that was no longer borrowed. Do that every month across millions of cardholders, and the industry was collecting billions in phantom interest charges that most people never even noticed. The Credit Card Act of 2009 banned the practice entirely. Congress found that double-cycle billing had been quietly draining American wallets for years, punishing the exact behavior the banks claimed to want, paying down your balance. Universal default. You have 3 credit cards. You've never missed a payment on 2 of them, but you're 5 days late on the 3rd. Maybe you were traveling, maybe you forgot. The next month, all 3 banks raise your interest rate, not just the one you were late on, all of them. This was called universal default. Before 2009, your credit card agreement gave the bank the right to raise your interest rate if you were late on any debt, a different credit card, a car payment, even a utility bill. One mistake anywhere in your financial life, and every credit card you owned could jump to the penalty rate. And here's the part that made it truly predatory. The rate increase applied retroactively to your existing balance. You could buy a laptop at 12% APR in January, miss a phone bill in March, and suddenly owe 29.99% on that same laptop. A purchase you made months ago under completely different terms. Let's put a number on that. Say you're carrying a $10,000 balance at 14% APR. Universal default kicks it to 29.99%. If you're making minimum payments, that rate jump adds over $8,200 in extra interest over the life of that balance, for being 5 days late on a completely unrelated bill. The Card Act killed universal default and retroactive rate hikes in one sweep. Banks can still raise your rate, but only on new purchases, only with 45 days notice, and only after your account has been open for at least a year. Negative amortization mortgages. Imagine making your mortgage payment every single month for 3 straight years, never missing once. And at the end of those 3 years, you owe more on your house than when you started. That's not a hypothetical. That's exactly what happened to millions of Americans. In the mid-2000s, lenders sold a product called a negative amortization mortgage. The way it worked was simple and devastating. Your monthly payment was set below the amount needed to cover the interest on your loan. The unpaid interest didn't disappear. It got added to your principal balance. So every month you made a payment, your debt actually grew. Here's a real example. A borrower takes out a $350,000 mortgage at 6.5% interest. A fully amortizing payment would be about $2,212 a month. But the lender offers a minimum payment option of $1,100. Sounds great, right? That missing $1,112 gets tacked onto the loan balance every single month. After 3 years of on-time payments, the borrower doesn't owe $350,000. They owe $390,000. They have been paying faithfully, and they're $40,000 deeper in debt. When home prices were rising, nobody noticed. Borrowers assumed they'd refinance before the real payments kicked in. But when the housing market crashed in 2007 and 2008, millions of these borrowers discovered they were underwater, owing more than their home was worth, with no way to refinance and no way out. The Dodd-Frank Act of 2010 effectively banned negative amortization by requiring all mortgages to meet a qualified mortgage standard, meaning the borrower's payment must actually pay down the loan, not grow it. No, doc. Liar loans. A pizza delivery driver walks into a mortgage broker's office. He earns $28,000 a year. He walks out approved for a $440,000 home. Nobody checked his income. Nobody asked for a pay stub, a W-2, or a tax return. He simply wrote a number on the application, and the bank said yes. These were called stated income loans. The industry had a more honest name for them: liar loans. The borrower stated their income, and the lender took their word for it. No documentation required, no verification, no questions asked, and it wasn't a fringe product. By 2006, roughly 40% of all subprime loans were generated through automated underwriting that required minimal or no documentation. Some lenders could approve a mortgage in 30 seconds, a process that used to take a week of careful underwriting. The math tells you exactly why lenders didn't care. A broker could originate a $400,000 liar loan, collect fees and commissions worth $8,000 to $12,000 at closing, and then sell the loan to Wall Street as part of a mortgage-backed security within weeks. By the time the borrower defaulted, the original lender had already been paid. The risk was someone else's problem. When home prices collapsed, liar loans defaulted at catastrophic rates. Borrowers who had inflated their income couldn't make the real payments. These loans were a key accelerant of the 2008 financial crisis, which wiped out roughly $7 trillion in American home equity. Dodd-Frank's ability to repay rule now requires lenders to verify income, employment, and debt before approving any mortgage. The days of writing a number on a napkin and getting a $500,000 loan are over. Yield, spread premiums. You walk into a mortgage broker's office. You have good credit. You qualify for a 5.5% interest rate, but the broker doesn't tell you that. Instead, he puts you in a 6.5% loan. Why? Because the lender pays the broker a secret bonus for every borrower they steer into a higher rate. That bonus was called a yield spread premium. Here's how the money worked. The lender would publish a rate sheet showing that for every quarter point above the par rate, the broker earns a percentage of the loan amount. So on a $300,000 mortgage, bumping the rate from 5.5% to 6.5% could earn the broker $6,000 to $9,000 in hidden compensation, on top of whatever fees they were already charging the borrower directly. The borrower never knew. They trusted the broker to find them the best rate, and the broker was financially incentivized to do the exact opposite. Let's run the 30-year math on that 1-point markup. On a $300,000 mortgage, the difference between 5.5% and 6.5% costs the borrower an extra $67,000 in total interest over the life of the loan. $67,000. So the broker could pocket a $6,000 bonus at closing, and it wasn't rare. More than 85% of subprime mortgages included yield spread premiums, with brokers typically collecting over $1,000 per loan for steering borrowers into more expensive products. Borrowers of color were hit hardest. Regardless of credit score, African Americans and Latinos were more than 3 times as likely to receive high-interest loans compared to white borrowers with similar credit profiles. The Federal Reserve banned yield spread premiums in 2011, and Dodd-Frank reinforced the ban. Brokers can still earn compensation, but they can no longer adjust their commission based on the interest rate of the loan. Single premium credit insurance. You're at the dealership. You've negotiated your car price, agreed on a monthly payment, and you're signing the final paperwork. Buried on page 9 is a charge for credit insurance. Nobody explained it. Nobody asked if you wanted it. But it's been rolled into your loan, and now you're paying interest on it for the next 5 years. Single premium credit insurance was a product designed to pay off your loan if you died or became disabled. In theory, it protected the borrower. In practice, it protected the lender's money, and it was wildly overpriced. Here's a typical example. A borrower takes out a $15,000 auto loan. The lender adds a $1,200 single premium credit insurance policy at closing. That $1,200 gets rolled into the loan principal, so the borrower is now financing $16,200. At 8% interest over 5 years, that $1,200 insurance policy actually costs the borrower about $1,500 after interest, for a policy that rarely paid out and that the borrower often didn't know was optional. The worst part? The lender typically earned a commission of 40 to 50% of the insurance premium. So on a $1,200 policy, the lender pocketed $500 to $600 before the borrower made a single payment. The product wasn't protecting the borrower. It was a profit center hidden inside the loan. Federal regulators and multiple states cracked down through the early 2000s. Dodd-Frank prohibited creditors from financing single-premium credit insurance products on covered mortgage loans. The practice hasn't disappeared entirely on smaller consumer loans, but the worst of it, the mandatory undisclosed rolled into your mortgage version, is gone. Bucket shops. It's 1902. You walk into a storefront on Wall Street. It looks like a brokerage. There's a ticker tape machine, a chalkboard with stock prices, and men in suits taking your order. You hand over $50 and bet that U.S. Steel will go up. But here's the thing, nobody actually buys any stock. Your money never touches the market. The shop simply takes the other side of your bet. If you're wrong, they keep your money. If you're right, they pay you if they feel like it. These were called bucket shops, and in the late 1800s and early 1900s, they were everywhere. They offered ordinary people the feeling of trading stocks without any of the protections of a real exchange. The shop owners knew that most customers would lose, so the math was simple. Take every bet, keep most of the money. The numbers were staggering for the era. At their peak, bucket shops were estimated to handle more volume than the New York Stock Exchange itself. Jesse Livermore, one of the most famous traders in American history, actually got banned from multiple bucket shops, not because he was cheating, but because he won too often and was costing them money. States began banning bucket shops in the early 1900s. New York made them illegal in 1908. But the real death blow came with the Securities Exchange Act of 1934, which created the SEC and required all securities transactions to go through regulated exchanges. Bucket shops are illegal today, but some critics argue the model never really died. It just evolved. When a modern trading app routes your options order to a market maker who pays for the privilege of taking the other side of your trade, some economists say that's a conversation worth having, but that's a different video. Penny stock pump and dumps. Your fax machine prints a newsletter you didn't subscribe to. It says a tiny company called MedTech Solutions is about to be acquired for 10 times its current price. The stock is trading at 12 cents. By the time you read the fax, check the price, and see that it's already climbing, you're convinced. You buy $5,000 worth. 2 weeks later, the stock is back to a penny. Your $5,000 is worth $400. The person who sent that fax? They made $2 million. This is a pump and dump, and for decades, it was the most reliable fraud on Wall Street. Here's the mechanics. A promoter buys millions of shares of a worthless penny stock for almost nothing. They then flood fax machines. And later, email inboxes and internet message boards, with fake hot tip newsletters hyping the stock. Regular people buy in, driving the price up. Once the price peaks, the promoter dumps all their shares and disappears. The math was brutal. A promoter could buy 10 million shares at a penny each. $100,000 total investment. After the pump campaign drives the price to 50 cents, those shares are worth $5 million. The promoter sells, pockets $4.9 million, and the stock collapses. Every dollar the promoter made came directly from regular investors who bought the hype. The SEC tightened penny stock regulations through the 1990s and 2000s, adding disclosure requirements, cold calling restrictions, and suitability rules. Pump and dump schemes are explicitly illegal under securities fraud laws. But the format keeps adapting. It moved from fax to email, to social media, to crypto. The SEC has brought cases where promoters made tens of millions before a single charge was filed, because the scheme moves faster than the enforcement. Churning. A 68-year-old retired teacher hands her $250,000 retirement savings to a stockbroker. She tells him she wants safe, steady income. Over the next year, the broker makes 187 trades in her account. At the end of the year, her portfolio is worth $214,000. She lost $36,000. But the broker? He earned $31,000 in commissions. This is called churning. When a broker buys and sells investments in your account not to make you money, but to generate trading commissions for themselves. Every trade, whether it helps you or not, puts money in the broker's pocket. The math is what makes churning so insidious. If a broker charges a 1.5% commission on each trade and makes 187 trades on a $250,000 account, the total commissions can easily exceed 12% of the portfolio's value in a single year. The S&P 500's average annual return is about 10%, so the broker was charging more in fees than the entire market typically earns. The client's portfolio didn't stand a chance. Churning was always technically illegal under securities law, classified as a form of fraud. But for decades, enforcement was nearly impossible because there was no easy way to flag excessive trading. The broker could always argue each individual trade was justified. That changed when electronic trading records made it possible to calculate a metric called the turnover ratio, how many times per year the entire portfolio is bought and sold. FINRA now monitors accounts automatically and flags brokers with abnormally high turnover. The rise of fee-only financial advisors and index fund investing has also made churning harder to hide. But for decades, it was one of the easiest ways for a broker to drain a client's account while looking like they were doing their job. The son of boss tax shelter. A businessman sells his company for $50 million. He owes the IRS roughly $10 million in capital gains taxes. His accountant at one of the biggest firms in the country tells him there's a way to make that tax bill disappear. Legally, for a fee of $500,000, the firm will set up a partnership structure that creates $50 million in artificial paper losses, completely wiping out the gain. On paper, the businessman made nothing. In reality, he kept $50 million and paid zero in taxes. This was called the son of boss, short for bond and option sales strategy. It was marketed by some of the biggest accounting firms, law firms, and investment banks in the country throughout the late 1990s. The mechanics were complex, but the result was simple. Wealthy individuals could erase real capital gains with fake partnership losses. The scale was staggering. The IRS identified over 1,800 taxpayers who used son-of-boss shelters, with total understated tax liabilities exceeding $6 billion. Not million, billion. Many individual participants had generated fake losses of between $10 million and $50 million. In several cases, the claimed losses exceeded $500 million. The IRS cracked down in 2000 and launched a settlement initiative in 2004. The terms were harsh. Concede 100% of the claimed losses, pay all back taxes plus interest, and accept a penalty of 10 to 20%. Despite those tough terms, 2/3 of participants came forward. By 2005, the IRS had collected over $3.2 billion. The typical settlement payment was almost $1 million, with 18 taxpayers paying more than $20 million each and one paying over $100 million. But the promoters faced consequences too. KPMG, one of the largest accounting firms in the world, admitted to generating at least $11 billion in phony tax losses. Several of its partners were indicted. The law firm Jenkins and Gilchrist, which had helped structure many of these deals, shut down entirely. 2 of its partners were found guilty of tax evasion. Son of Boss didn't just cost the Treasury $6 billion. It proved that the most respected firms in American finance were willing to build and sell financial fictions for the right fee. The shelters have been shut down. The accounting rules have been rewritten. But the question it raised hasn't gone away. If the smartest people in the room are designing ways to pay nothing, who's actually paying for everything?